Hi everyone. Long time no see. Welcome back to our Turning Point show. We have Rowan Van Battenborg, CFA, longtime contributor to the Bird Shops Report, and of course, New York Times bestselling author and CEO of the Bird Shops Report, Larry McDonough. Of course, you can get his new book down below. You can click the link and pre-order it now. Remember, it's gonna come out in March 26th. So today, there's a beast underneath the surface of the market, which is highly connected to the upcoming election. We have big news out of the Fed, the Treasury next week, and a very powerful market moving events with all of these meetings happening next week. Guys, can you tell me all about it, please?
Thank you, Valentina. Great intro. Yeah, our book is 2 months away, and one of the key parts of the book, as we talk about the politicization, how the Fed, much like some other governments in the world, slowly but surely, this incredible amount of government spending, $1 trillion in the most recent 3-4 months of additional deficit spending, is putting more and more pressure on the Fed. The opportunities are incredible. We'll highlight them on our private call this week with clients, and then we have a special report coming out. The opportunities are just really setting up for the second half of the year, or say the second quarter to the end of the year. We're going to have an incredible move in the markets. The one thing, Rob, I want to get into. So walk us through the catalyst for next week. We've got runaway deficit spending. We've got kind of where everything's coming to a head, because in some ways, Treasury's starting to try to influence the election by spending a lot of money, by doing a lot of different things. But then the Fed is up against some potential liquidity stress at some point in the year. But what's happening next week? What's yelling? Why should investors care about next week? It's not just the Fed meeting. Why else?
Well, this goes back to October of last year, where we started to see that some of the levers that the administration, which includes the Fed, have at their disposal, they started to push into their favor in order to start to suppress volatility. So bank reserves started to move up. That's in line with the RP being drawn down. That's the reserve for the reserve facility, the reverse repo facility. They're starting to draw it down in order to finance the issuance of bills in order to fund the government. It's a great
So walk us through that. So the government. So think of like bonds and risk for people watching us right now. They can issue longer term bonds, which carry very high movement and volatility. So if interest rates go up, bond prices go down. On a 10-year bond prices go down a lot more. So in some ways, typically the Treasury should issue very small amounts of bills historically, and no more than 15-20%. But if they're now issuing lots of bills the last year, isn't that also juicing liquidity as well? And we get data on that next week.
Yeah. So once they signed the budget debt ceiling deal in June, Janet Yellen started issuing an enormous amount of treasuries into the market, bills, bonds, notes, the whole thing, because she wasn't able to issue any paper in the first half of 2023. Once the deal was done, she pushed a wall of treasuries, I think something like $2 trillion into the market. How did she fund that? She funded that through a disproportionate amount of bill issuance, because she knew that a reverse repo facility would put that money, it was more than $2 trillion in that thing, put that money out of the RRP into the bills market. Because
okay, so walk us through that. So instead of issuing long-term bonds, which so that means investors have to own longer-term, more volatile bonds, so you're issuing lots of T-bills.
Yes.
And then connect that to the RRP.
Okay, so the RRP is capital that is sitting on the sideline. It's not part of liquidity. It's a facility that money market funds can put the money in, and they get paid a certain interest rate, which is very close to the Fed funds rate on it. So if a lot of bills are being issued, then the bill yield goes above the yield in the RP, which money market funds basically then take money out of that facility and put it in the bills market. And that's exactly what Janet Yellen wanted. She wanted that money, which was not part of liquidity, sitting on the sidelines, being paid by the Fed, that money, she wanted that money into the market in order to fund the government, which is running such obscenely large budget deficits. She wanted to do that because she knew if that money in that facility wasn't coming out of there and fund all those bills, it would be a massive drain on liquidity, pushing the market down. And her goal is to fund the government and get the market up, suppressing volatility, because she needs to win an election next year. And very little to show for her, I have to say, for the administration. But if they can get the stock market up, then the suburban voter is going to be very happy. They don't care what's happening in DC, how dysfunctional it is. They're looking at their 401k, they're looking at their IRA, and they will pull the lever for Joe Biden in November. So that's the main goal of this entire Byzantine maze of tools that they have at their disposal. So that's what happens.
So let me ask you a question. So we've been lectured for decades, especially the last 10 years, that Treasury and Fed, there's no political influence. The Treasury does not influence the Fed at all. But it's very clear that if you're all of a sudden going from issuing, you should be issuing longer term bonds. You should have issued a lot more longer term bonds over the last couple of years. Now you're issuing, an incredible amount of T-bills, so shorter term securities, and that's putting more and more pressure on the Fed, because doesn't that eventually connect the liquidity issue of the RRPs? The RRP on the chart is falling, and what institutional clients tell me in the chat is if the RRP gets too low, you're going to have a liquidity event. How does that connect to the Fed potentially stopping, or tapering or stopping QT, quantitative tightening?
Right. So now we're going from October of last year, and then we went to November. And when in November, Janet Yellen did something very clever, is she made an announcement. The regular scheduled, that's the update on the funding announcement. And that's where she started tapering the issuance of longer dated bonds. And that's triggered.
And asset prices love that, right? From that moment when she changed, so she could have announced more longer term bonds to issue. But once again, when she does that, when she issues long-term bonds and interest rates are, say, going up or volatile, those long-term bonds move around in price, and it creates more volatility in the market. So she, like you said, starting in November, she moved a lot of that issuance to the front end, and then all of a sudden, we had a big move in asset prices.
Yes, bond yields went down. The bond market was a millstone around the neck of the stock market. So she knew she had to do something. So she made an announcement. Bonds made a dramatic turnaround, and that set in motion a big rally in the stock market as well. Now she's faced with another challenge, because on Monday she has to make an announcement on the deficit. So that's the first part of what is happening next week. So she's going to have
to explain that. So she has to. Okay, so we know we did $1 trillion of deficit spending over the last 3-4 months, which is one of the fastest paces of all time, and so she now has to make an announcement about how much bond she's going to have to sell relative to government spending.
Yes, she has on Monday. She has to make an announcement about her financing needs. So she's probably going to raise the financing needs. Back in November, she thought she needed about $816 billion. That's probably moving to $1 trillion. And then on Wednesday morning, she's going to announce the auction sizes. So how much she's going to, the Treasury is going to issue of each and every maturity. So 6 months, 12 months, 2 years, 3, 5, 10, 30. So it's very important because the market is fearful that she's going to have to raise all the auction sizes. And it's our belief that she's going to pull the same trick as she did in November. and she's going to primarily raise the auction sizes of short-term bills and leave the longer dated maturities pretty much alone. And that could cause another relief rally in the treasury market. But what's more important is that it forces the Fed, which is the other side of this serpent, it forces the Fed to start quantitative to start
Okay, so this is great. So let's walk through this. So the Treasury, which claims independence from the Fed, wants to win an election. And they prefer to continue to ramp up T-bill issuance, as you can see there in the chart. You can see that explosion in T-bill issuance. And so, but when she does that, how does that potentially force the Fed? So essentially, if she does that and she's forcing the Fed, she's actually conducting monetary policy, which is insane for the U.S. Treasury. So how does she force the Fed into possible quantitative tightening, which means, let's explain what that is, less asset purchases? So explain that connection.
Yeah, so, well, remember that the Fed, who claims to be politically independent, is pretty much all appointed by Biden right now. So it's happy to appease Janet Yellen and dance to her tune. So by issuing so much more bills relative to all the other option sizes, she's forcing more RRP money out of that reverse repo facility into the market.
But explain that. How is she forcing it? Like, how is?
Well, because bill yields will go trade above the rate of the interest what is being paid on the reserve.
I see. So she issues more bills, like in size. So all of a sudden, the yield goes up because she's selling more.
Yes.
And then there's a higher yield on the bills relative to the RP, and that drains the RP.
That will drain the RP further, although it should, and the Fed knows that is something that is likely to happen. By doing that, by draining that further now, as it has already gone down from 2 trillion to 600 billion. Now
the RP's gone from 2 trillion to 600 billion.
Yes.
It's and a lot of acceleration in recent months, I'm told by some of the clients.
A lot of acceleration in recent months. But now we reach the point whereby the RRP is at a level that it makes the Fed concerned about tight liquidity conditions in the overnight lending market. So we already saw in the end of December that SOFR, which is has replaced LIBOR as the interbank lending market rate, spiked at various occasions because of year-end and quarter-end balance sheet restrictions of the banks. It's a little bit of a technical story here, but the Fed doesn't want to see that. They don't want to see SOFR yields spike out of control. So they will do anything possible to prevent that from happening. So they can do that by starting to taper quantitative tightening. Remember, quantitative tightening is essentially draining liquidity out of the market. They're draining about $90 billion per month out of the market.
So the Fed's Treasury's trying to sell bonds around the world, right? Last year and a half. At the same time as they're trying to sell bonds, the U.S. Treasury, to all kinds of investors in the world, the Fed has been reducing the balance sheet, reducing their asset purchases. So the Fed's becoming a smaller and smaller player in the market.
Yeah.
And now Treasury, and this gets to the dollar, and here's where the trade is. So if Treasury gets aggressive and tries to juice this election, which they're clearly doing, you can see that chart there, by issuing more T-bills relative to longer dated bonds. Remember, longer dated bonds are the things that blew up Silicon Valley Bank, right? And so all of that volatility on the long end created a tremendous amount of equity volatility and a crisis in the bond market. So by issuing more front-end paper, which is bills, she's creating a better environment for risk taking, right? And so there's more risk taking, asset prices going up. But if the Fed gets force Rob into ending QT early, that weakens the dollar, and all of a sudden we have a revival in inflation later in the year. But connect the dollar, because that's where the trade is in terms of different assets. Like there's winners and losers with a weaker dollar.
Yeah, well, the Fed wants to pivot to a monetary accommodation. We heard Bullard yesterday, who is a former president of the Fed, St. Louis. He's retired since, but the Fed is in the quiet period right now. We heard him say on a podcast that he thinks that the Fed will start cutting rates in March. So cutting rate in March, start tapering quantitative tightening. So these are two levers that the Fed has in order to suppress volatility and drive asset prices higher. Because the Fed will do also what it can in order to get the market up, for the election. So you have, on the one hand, you have Treasury. You have Janet Yellen is forcing the Fed into quantitative tightening taper, stop selling those assets on the balance sheet, and cutting interest rates. Now, this also ties into, of course, the situation that where interest rates are still naggingly high, and it causes Main Street a lot of pain, right? You have auto financing, which is down a lot.
Yeah, that's why that mortgage, you could see ever since November, and this gets back to she's trying to clearly, they brought down mortgage rates a lot. And that was ever since November, because remember, the point that Rob's making is they've gone from issuing more longer dated paper to issuing more and more shorter dated paper. And that's where you see that beautiful yield drop in the 30-year mortgage. And that helps the housing market, that helps it's that 30-year rally and that 10-year rally helped a lot of things. And that's where you get into some of the politics of it too. Rob, think about the planet Earth, right? Because the dollar, let's just think about the dollar and the trade here. Because if the Fed is developing an easier monetary stance than the rest of the world, and right now we have a 5.1 unemployment rate in California, which is almost $4 trillion of GDP in California. It's 5.1% unemployment, one of the highest statewide unemployment rates in the country, much higher than the U.S. itself. And so the U.S. economy is weakening, the Fed's easing. At the same time, in Europe, you've got this Suez Canal, and it's much more inflationary for them because you've talked about this at great length, where you've got supplies and you've got all kinds of oil, all kinds of transports that have to go around the Cape of Hope, around South Africa. And so that's much more inflationary for Europe than is the United States. So then all of a sudden you have a slightly more hawkish ECB and Bank of England. That creates a weaker dollar. And at the same time, you've got a China that's doing a fiscal and monetary response. And so all this together potentially gets you an incredible move in asset prices, particularly say hard assets, metals, oil and gas names that are actually pretty cheap.
Yeah. Well, yeah. So going back to the Fed, their goal, they're still dealing with a nagging monetary tightening situation whereby it cuts off a lot of business activity. Mortgage rates are a textbook example. Mortgage rates are still extremely high, even even since November. You have a drop of about 100 basis points in the mortgage rate. But the housing market is still frozen. Existing home sales are still at the level where they were in just after the great financial crisis. New home sales are doing okay, but that's just a small part of the market. And a lot of people are pushed into the new housing market because there's no secondary existing homes for sale. People don't want to sell their house. They're locked into their home. It's an incredible story. So here you have new home buyers.
Yeah, they don't want to sell their house because they don't want to have to refinance it at that higher rate.
Yes, unlike Canada, the United States doesn't have mortgage portability. So you sell your house, either you have to go into a multifamily unit, paying a lot of rent for an apartment, or you have to go out and get a mortgage which is 6.5%, 7%, whereas the mortgage you had on your existing home that you just sold was probably 2.5% to 3%. So not many do it. So that's a big problem, right? Housing affordability is a big problem.
Yeah,
it's a centerpiece, especially in an election year.
Election year. and
So you
and then
would, yeah, a lot of
and then
times.
the
Yeah.
800-pound gorilla in the room. So I was on Fox yesterday with Don Peoples, and he makes the point around, he's a veteran commercial real estate, developer, one of the most accomplished real estate players in the U.S. over decades, really accomplished guy. And we were on with Maria, and he's like, there's close to 2 trillion of, according to Don, of maturities in commercial real estate, and the banks, the smaller to mid-sized banks have about 30% of their net tangible equity in commercial real estate. So if rates don't come down, Don's expecting a massive default cycle, but it's a slow moving train wreck because it's moving very slowly. In other words, these maturities are over the next 2 years. But then in the high yield market, you've got 1.9 trillion of high yield leveraged loans and investment grade bonds in the United States. So if you put those two together, 1.9 trillion of commercial real estate, another one, you have 3.5 to 4 trillion of maturities in the next 24 months. That if the Fed leaves rates here, anywhere near here, we're going to have a colossal Lehman-like credit crisis. So the pressure on the Fed is to really cut rates aggressively this year. Isn't that the big pressure?
Of course, they want to. They want to cut rates. They think that the real rate is now burdensomely high because inflation has come down, in the range of their target on PCE. So they want to cut the rates. If they're assuming a PCE of about 2% and their Fed funds rate is at 5.3%, you're talking about more than 3% real rates. So they want to cut rates. They want to start tapering QT. Janet Yellen is going to push them in that direction. And then she will also announce a small bond buyback program, which has been in the works for a very long time. She's been talking about it. Of course, she's doing it this year. The timing couldn't be better, right? Unsurprisingly, which facilitates, that's a bond buyback program, something like $30 to $50 billion per quarter. It's not that much, but it's her intention to use that to buy longer maturity treasuries off the run. So the treasuries that have been issued many months ago that are not that liquid, because she wants to facilitate the liquidity at the long end.
But don't you see what's happening here? I mean, this is the road to Argentina. This is the road to Venezuela. I mean, when you politicize, when all of a sudden the treasury is becoming more and more and more, the treasury is becoming more and more like the Fed, and you've got a political element there. You've got election cycles, and the way this country was founded and developed over the last, 275 years was through election cycles that were not directly connected to monetary policy. That's an Argentina-Venezuela thing. That's a road to serfdom. And that's a big problem. And I know they don't like Mr. Trump, but they're really, people need to make some noise here. This puts the republic in jeopardy.
Well, remember that Joe Biden, one of the ways that he thought he could win the election in 2020, that he doubled the amount of money that he was going to send every household. Trump, at the end of somewhere in the third quarter of 2020, announced that he were going to send more checks to households, and Biden said, "Oh, I'll double it." Right. So for them, throwing a lot of money into an election and promising people money in their pocket and what have you not, it's no stranger. It's no strange tactic. I mean, we've seen this movie all before. And remember,
but think about the last 200 years. Yeah, but think about the last 200 years. If you wanted to do that, you would have to raise taxes. And now you've got Janet Yellen buying all of our T-bills. I mean, I'm sorry, you got the Fed. Buying, being forced into to buy all these T-bills. So instead of issuing longer dated paper to China and the rest of the world, because we have to finance this horrific deficit, Yellen can just increase at Treasury her issuance in the short end, and force the Fed to buy that.
Yeah, and remember, before we forget, she also has $750 billion in the Treasury General account, which is sort of like the checking account that the Treasury has held, it's held at the Fed. She's kept it at 750 billion. But I'll tell you that she's going to drive down that Treasury general account towards in the last months of the year into the election. Because by doing so, she has to issue less paper, which drives down yields even more, which props up asset prices even more. Now, I'll tell you this. It may start another inflation cycle, but they don't care. All they care about is the first week of November. After that, they're done. They don't care if that starts another inflation madhouse. All they care about is they're playing for the next 8 months.
Yeah, and when I said, force the Fed, what's going to happen over the next year is if inflation rises and yields don't come down, that's where the Fed gets forced into QE at some point in the next year. Because, like we said, we have 1.5 to 1.9 trillion of commercial real estate in the next 24 months. You have another 1.9 of high yield leverage loans and investment grade bonds. So you have all these refinancings, and right now the rates are so high that it just forces the Fed into some type of QE within the next year. That gets you the weaker dollar. So if the U.S. is weakening now, and the Fed is cutting rates, and then ends quantitative tightening and starts to cut, that gets you an even weaker dollar. That's oil supportive. That's commodity supportive. At the same time, if the rest of the world's improving because of the China stimulus, that gets you a really crazy dynamic where, you're going to have this revival in inflation. Now, that's the thing. That's the dangerous thing is they could have a revival of inflation heading into the election.
Yeah, well, and let's not forget that the Treasury themselves pays much higher rates. Almost every day they have to refinance debt, right? So this year alone, 7 trillion of debt is maturing. Now, that debt was issued probably between 2009 and 2020 at rates which were a fraction of sometimes 1.9%, 2% on 10-year, right? And that's maturing now. And now they have to go into the market and refinance it at 4.5%, 5%. So the interest on the debt servicing cost for the government has exploded. They have absolutely exploded. They're near $100 billion per month now, per month. So these are astonishing numbers. And so there's a very powerful incentive for both Yellen and for Powell to get the Fed funds rate lower, push that thing down because it reduces their financing costs. And that will eventually also lead to less of a budget deficit, which, has the budget deficit is up like 15% relative to even last year. So there's no way we've seen any improvement in the fiscal situation of the U.S. government. No way. It's still growing by leaps and bounds.
Okay, so Rob, the boogeyman question is, we had 80 billion of interest that was owed on the U.S. debt in November for just the month of November, 80 billion, and that's up from two years ago of 25, 30 billion dollars, something like that. So
Right.
now, if we're at 80 billion a month of interest, that starts to crowd out fiscal policy. How does that impact? Like, what's the Fed up to? If we're starting to crowd out defense spending or medical, advancement, spending on healthcare advancement or any kind of genomics, whatever it is, in discretionary spending, if interest on the debt crowds out discretionary spending, then politically, once again, the Fed's in a box.
Yeah, so it's a big challenge for the federal government because entitlements in general are going up by double digits. Like, it's not just the interest service costs on the debt, which are now $80 to $100 billion a month, but it's also Social Security, Medicare, Medicaid, and defense spending still goes up at 10%. So it eventually will crowd out non-defense discretionary spending, which is everything that goes to infrastructure, education, investment in the country, you name it. So it's
So
a
where's the trade? How does that impact your
so
portfolio?
it's a strong motivator for the Fed to start cutting rates as soon as possible. Um, because as we discussed before, the Treasury has to refinance about $7 trillion this year in debt. So that $7 trillion was probably financed at rates between 1% and 2%, and now they have to go into the market and issue it again between 4% and 5%. So if the Fed starts cutting interest rates, and with Janet Yellen very front loaded the issuance, that means that with the front end of the curve is following the Fed funds rate very closely. That means that it will be less of a burden for the federal government to refinance all that debt. It'll be at least they'll have a little bit more control over the debt servicing cost. So that's another motivator for the Fed to start cutting interest rates as soon as possible. So it all comes back to, what's happening next week with the quarterly refunding, and how much is the Fed willing to signal this on Wednesday? How much are they going to signal they're going to phase out quantitative tightening, which is a
Okay,
big,
so let's
big
get into
factor.
that. So next week, what are the things to listen for? So for the person sitting at home right now, or clients around the world, like what? Obviously, if they issue a lot of paper on the front end and continue that, that's a signal. But what are the signals next week to look for?
Yeah. So, for example, if Janet Yellen on Wednesday morning comes out and she does what we expect her to do, very front month loaded, long end yields will probably go down. It'd be good for gold.
And that's because, hold on, let's go. So if her bond issuance, future bond issuance over the next year is front end loaded, that means she's going to sell more bills and not
Yes.
as many 30 years.
Right.
And that's why bond yields go down.
That should drive down bond yields, yes, and that's very positive for gold. Um, it could all, yeah, and the upside, the antithesis of gold is the dollar, so it should weaken the dollar, it should drive up the prices of gold.
Emerging markets benefit there, all kinds of, not just gold, platinum, palladium. A lot of this stuff is really beaten up. I mean, if you look at, so there's 21 trillion in the NASDAQ 100, and then there's only about, I think, less than a trillion in the XME, uranium, platinum, palladium, gold, silver. You know what I mean? So there's 21 trillion in the NASDAQ 100, but there's less than a trillion in all the metals and all the miners in the world.
Right. So it should also help financial assets, right? Phasing out quantitative tightening, the Fed signals that is going to phase out quantitative tightening. That means more liquidity into the market. That means, inflating all kinds of assets.
But remember, we saw this in 2022 when you had higher inflation bounced, value stocks and harder assets dramatically, in oil and gas dramatically outperformed financial assets in the inflationary environment of 2022. So if you get a dollar weaker, inflation revives, and you get a bounce, because it looks to me like everybody's expecting inflation just to go back to its merry old spot of 0 to 1. But if you get a bounce in inflation, how is that good for all financial assets?
Well, the inflation comes later. Right now, people are gun ho about how the authorities are injecting an enormous amount of liquidity in the markets. The market is on steroids because of that. If that eventually leads to a pickup in inflation, that's where that trade starts to come into play. So we're watching the Fed, we're watching quantitative tightening. Are they signaling? Is Powell going to signal that they're going to start phasing it out in March? That's in the press conference on Wednesday. Is Powell going to signal? Is he going to echo the comments from James Bullard that they are going to cut rates in March? Right now, the odds are about 50%, so 50-50. The Fed wants those odds at 100% by March, right? They are so hell bent on guiding.
Yeah, that's a good point. If they're going to cut in March, that's a great point. If they're going to cut in March, then they need to start to move up those expectations, because they don't want to surprise the market, right?
No, not at all.
So if they're going to cut in March, they got to start signaling soon.
Yes. Yes, they're going to have to start signaling it. So we have Powell in the press conference. He's going to have to signal that on Wednesday. If he plans to start cutting rates in March, we're going to have to hear something from him on that front. So this is a very important week, and we'll look forward to it.
Yeah, it's a very progressive Fed board. I think the QT thing is easier for them to do now, the quantitative tightening. So right now there's still quantitative tightening, and they could taper that, or they could end it, say, create a deadline for, say, June, July, August, when that quantitative tightening is over. So we could either have that, or we could get some real kind of aggressive dovish talk to try to talk up rate cuts, or both. But so you could get one or the other or both, but you're most likely to probably get the QT now and then a little bit softer Fed speak later.
Well, yeah, well, they move very slowly. Remember that, when inflation was running away in November of 2021, Powell was only signaling that he was going to, start tapering QE in the beginning of 2022. I mean, they were still buying bonds. They were still doing QE in the first quarter of 2022 when oil went to $125 a barrel, right? They moved like molasses. So if they want to phase out quantitative tightening by the summer of this year, which perfectly aligns with their playbook for the election, that means they're going to have to signal it next week, and they have to start tapering it slowly in March in order to completely phase it out this summer. So I suspect something along those lines is probably going to happen.
Well, great to catch up, guys. I've got a couple calls I got to get on. Thank you so much, and you guys can finish up. Appreciate it.
Okay, so thank you guys for such an insightful conversation. We'll catch up with next week. We're gonna follow up after the meeting, after the treasury, everything. So Rob, I'll see you next week. Guys, thank you so much for joining us. As you saw in Larry's background, we run a Bloomberg live chat with more than 660 investors all around the world. You can get a free trial for that if you reach me at valentina@theredtrapsreport.com. You can find that below. And if you don't have a Bloomberg terminal, don't worry, I have the option just for you. You can get our Turning Point, which is our weekly macroeconomic recap and overview and client chat recap for 21 days. You can reach me out on the link down below and also pre-order our upcoming book. Thank you very much.